Welcome to another episode of the Smart City Podcast. Today, it's a live broadcast with Julia Wilkinson on the subject of ESG and sustainability, in particular, a focus on the investment world. Julia, let's give our attendees a few seconds to join in before you launch into your introduction.
Perfect. Thanks so much for having me, though.
Hey, it's great to have you. It's great to see you again. Julia was one of our speakers at our ARC Orlando Forum in June. Anyone who's listening to this broadcast, we urge you to consider attending our next upcoming ARC Forum in Orlando, February, the first week of February, where we will be focusing on sustainability and energy in transition.
It was a fantastic event. I really highly recommend it. Not only did
we were thrilled to have you.
Thank you. I really learned a lot, as well as meeting great people.
That's great. Okay, well, we're at 8. We're at 1 after the hour, so we can get started. So Julia, just for background information, can you tell us a little bit about yourself and how you came to this whole ESG sustainability and investing space?
Sure, absolutely. So I'm the CEO of Imvest. We focus on capacity building, training, mentoring, and doing diligence for investors on impact and ESG. Those investors include fund managers themselves, so imagine traditional VCs or impact VCs migrating into the space of measuring, managing, and measuring value in their portfolios across impact verticals. We do diligence on managers for investors. We help them work through what values to focus on and how to create milestones both at the corporate level and in their portfolio. And we've also loved the early stage innovators. So we angel invest, capacity build, and accelerate entrepreneurs as well in the space. My personal background is what inspired me to get into this industry is my parents were US diplomats. My mother worked on the environment for the US Embassy in Brazil, Mexico, and different countries. My father, political attaché. So we lived in many emerging markets where both inequality was a large issue, and protecting the environment was a matter of international value and security, like the Amazon. So I really got interested in learning about innovative ways to finance, protect those segments. However, my career path took a slightly different approach, which was I left undergraduate school and decided to work in finance for the first sort of 6 or 7 years of my career, so I could learn how the capital markets worked and understand the dynamism and the power behind it. In that capacity, I went to work for Goldman Sachs here in Miami, which is where I'm reporting from today, and focused on private wealth management in Latin America, so primarily Brazil and different regions there. And that's when, during the financial crisis, I learned about the term ESG and impact investing. The firm was starting to do things internally on that subject and offer it to clients. And I got excited about being able to combine policy, diplomacy, and impact with finance. So I focused on that segment, studied it in grad school, started my own firm to focus on helping different individuals understand and enter that market. And that was about 6 years ago today.
Well, that's a fascinating background. I learned a lot about you as well. So before we launch into the particulars, how about giving us just an overview of, what is ESG? And I know it's a big term. There's lots of issues around ESG, but try to give us a comprehensive perspective of, what is ESG? Where did it come from? Where is it today?
Okay, so ESG stands for environmental social governance, and it is basically perceived differently by different people, but let's say it goes into 3 main buckets. One is managing risks associated with those 3 words: environmental risks, whether that be in a portfolio of investments or in a corporation; social risks whether those be how employee retention, the rights of gender equality at a firm, diversity in the management, et cetera, or governance risks, risk of the board not being independent enough, risks of the executive compensation not being tied to performance, et cetera. And that's the first bucket. The second is that some ESG investors or managers are looking also to integrate or focus on the opportunities in sustainability. So that means they're going beyond taking a focus on risk and really looking at how they can benefit stakeholders in their supply chain or benefit the company by focusing on a new vertical, let's say e-mobility, which is very trendy and hot and potentially receiving a lot of spending from the government and others. So you're looking beyond risks for opportunities to either improve efficiencies in your corporate structure, retain and preserve better employees who are excited about new emerging economies, et cetera. And the other bucket is a little bit beyond ESG, and we call it where you're really focused on contributing solutions. So you're not just looking at risk or some opportunities that also improve your bottom line, but you're actually either building a company or a portfolio that is built to contribute to a solution to a major problem, whether that's climate change, inequality, global health crises, et cetera. So taking a pause up there, where did this come from? ESG in some capacity has been around for over 30 years. The original form of ESG was focused more on screening out industries than focusing on reducing risks in existing ones. To give you an example, one of the first risks to be screened out was tobacco. Some investors said, you know what, I don't do investments in tobacco because of the impact on the public, and that is a cost that ultimately taxpayers really pay to help people who are sick with cancer from cigarettes, for example. So some investors started screening out things like that, while also, let's say, being overweight, perhaps other industries that were less focused on producing either sin stocks or fossil fuels. Later, that grew with momentum, with sophistication as new entrants also got involved. A few factors really sped it up. One is the financial crisis of 2007, which really helped governments around the world unify and try to create better ways for banks to really function as in service of the public good, to make sure that global financial risks were understood and could be contained. So for example, if one financial institution is at risk, do we really understand how they're connected to all the other ones, such as Lehman, right? Lehman going under caused almost a global crisis. And the really regulators did not understand how deeply everything was intertwined there. So that was the first kind of, let's say, S&G focused transition that really led to a lot of banks offering new products, thinking about how they engaged the market differently, and improving the way they compensate and align their interests with the public good. A couple other factors that really have driven it as well. Broadening inequality, right? The crisis increased inequality. So did COVID-19. So has certain environmental risks. So unfortunately, that inequality is still a big issue globally. Technology and global connection have made it a lot harder for companies or anyone to hide anything wrong that they're doing. So before, it would take weeks, if not years, for a scandal to reach the globe. Now it's almost immediate. And it's on social media. People are, boycotting companies within a day of a crisis, maybe unfairly, but that is now something that the mass mentality is able to do because of technology. I believe there's more consensus on climate, which is also driving the risks of climate change. So, before we were debating, is it even real? Is it going to happen? Now there's a lot of data pointing to banks pricing it into stocks, financial regulators regulating emissions or regulating reporting on emissions across industries. So you're seeing like a shift from is it going to happen to it's going to happen, and how do we price it into analysts' understanding. Lastly, low switching costs have also increased. So, there's more, it's easier to switch from one brand to another if you don't like what they're doing than it was 50 years ago, where maybe there was only one brand available to you, period. So it's a little bit easier for people to change their minds depending on what part of supply chain you're in. And in a way, the COVID-19 crisis has also accelerated it. I believe the reason is people realize that life is fragile, that coming together to collaborate on a major issue globally is possible, right? We all kind of, for the most part, put aside our differences and rally towards trying to address both, the science and behind vaccines, for example. That's an unprecedented collaboration, trying to help shift supply chains during crisis. And also it brought to the attention of many that there are challenges, right? If there is a global crisis like COVID, like the climate change crisis, this causes logistics problems, supply chains problems, and all kinds of things that we need to be prepared for if there's another pandemic or climate crisis. So I'll stop there because that's a lot.
Well, thanks, Julia. Before we move on to impact investing, I'm looking at some of the notes we had discussed, and one of your points was that ESG measurement focuses around key indicators that may differ depending on analyst predictions and weightings, religious or political views, and or sector materiality scores from various accounting bodies that are resident in different parts of the world. Can you touch on, that's a very contentious issue and is a political hot potato at present, but can you touch on that a little bit? Is there consensus around ESG scoring?
No, there is not consensus, which I actually think is a healthy thing. There's not consensus from financial analysts at any firm about any stock, let alone any scientist about most major things except maybe climate change or etc. So I actually don't think that's too bad a thing. But I think it's also important to touch on, okay, the analysts at a Wall Street firm are looking for certain things that might be different from an investor group itself. So that's why I mentioned religious and political views, right? You, the investor, if you're a private wealth investor, or if you're controlling a specific segment of, let's say, a religious organization's wealth, may actually have a different view of what ESG means than another person based on your religious or political views, etc. But you may still find some elements of this both important to your family legacy or an important risk factor that you want to address globally, etc. That said, on the materiality scores, so there's also different accounting bodies, kind of like there's S&P and Moody's, et cetera, that rate different different bond positions or credit risk differently. These analysts also have slightly different weightings on how a material risk affects an industry. So for example, the cruise line industry, I think SASB overweights environmental crises as having an effect on ROI. They tend to grab more headline risk. It affects the industry more than some of the labor rights in their value chain. So their analysis is that the environment is one of the most important from a material risk perspective to ROI. However, in other industries like service industries, banking, potentially more weighting is focused on the S and the G than the E, right? Because A, their business may be less directly impacting the environment, but also their employees are very important to their business model, as are their customers, and valuing the S and the G may have a higher weight in a risk scoring towards ROI, having an impact on ROI. Does that make sense to you?
It does. So before we move into impact investing itself, what are the complications and the obstacles, the impediments towards moving this philosophy forward?
Some of the obstacles are understanding the rating system. So this is new to many people. So people looking from the outside might say, okay, why are there differences in ratings between companies? How do I dig deeper? So that challenge requires education, right? People need to learn what ESG means, from in their firm's perspective, how to be able to explain it to their customers, how to really understand it. And then also potentially they need to be able to compare apples to apples a little bit more easily, right? How do I look at one fund versus another and really understand how they measure ESG, what their weightings are? Does that align with my personal values as an investor, or my understanding of the risks and returns that are, the risks of the market and the potential return that could lead to. So that's why the SEC is currently debating and has proposed that managers in the space will have to disclose more information about the process. Not necessarily are they limiting what they can do, but they're saying, listen, you really have to be more clear so that if investors looking at, a, ETF from BlackRock and an ETF from MSCI, and they're both claiming to be ESG, how do I really understand what the differences are? Is there any trade-offs being made here that may bring additional risk to me? Because I think that's something that people are experiencing right now in the market. Some ESG investment funds are overweight technology because technology companies tend to do better at ESG scoring, and I can explain why after. And underweight fossil fuels, right? So that right now in this current market means that they're probably underperforming the S&P, right? Because the S&P has oil stocks and is more balanced across different industries. But if you're in a overweight technology, underweight oil and gas fund, you're probably underperforming. So not everyone understood the risk going in, and some people are feeling like they were maybe misled. And that's why it's very important that people have more information and more disclosure in the future, both to avoid greenwashing and ESG washing, so that they can better make decisions and that they understand the risks they're getting into better.
So, Julia, that's been a great foundational, description and history of ESG, as well as the challenges we face here today. So, let's move on to our next question in our sequences. What does that imply for impact investing itself, and what is impact investing?
Okay, yeah, let's definitely talk about that for a second. So, impact investing is different from ESG generally. Most impact investors do have an ESG screen in their portfolio, but that's not the ultimate purpose of the portfolio. Impact investors are intentionally investing towards positive and measurable social and environmental returns, as well as financial. That means, let's say they set out with the thesis, I want to build a portfolio that is going to mitigate climate change and build resilience for adaptation purposes. So we at Invest are doing something similar right now, building an impact investment portfolio of managers that addresses the systemic causes of climate change and also focuses on adaptation. Now, that means that not only am I screening out certain risks and I'm concerned about making sure diversity and inclusion is considered, but really the investments are focused not just on building something that is market rate driven, which is the goal, market rate driven, but also where the impact of the portfolio is specifically to contribute to a solution. So that's an important difference. That market is much smaller than ESG. So ESG labeled investment managers now account for $1 in every $3 globally, which is approximately, I believe, 40 trillion out of $120 million, 120 trillion assets under management globally. Whereas impact investing is only 1 trillion. It just hit the 1 trillion mark this year, which is exciting because that means despite market shifts, people are still increasing their investments in impact. And that reflects that this is a much more nuanced, much more small niche focused managers doing this, which I also think is a good thing. These issues that we're talking about, as we discussed, are complicated. There's many causes and effects. Not all of them, as you mentioned before the call, are completely proven that the cause has the effect that we understand, right? There's still a lot of question marks. So these impact investors are really focused on a specific segment, let's say sustainable agriculture. How do we improve efficiencies, reduce fertilizer use, improve distribution of farms around the world so that they're not destroyed by a climate crisis in one go, for example.
So would it be correct to state that impact investing is a subset of the ESG ecosystem?
Yeah, I would call it like a subset, yes, because it's taking a step beyond ESG and building a very nuanced, focused strategy. Now, I think eventually, so personally, I believe that ESG will continue to grow and that every financial institution and probably every corporation will include some aspect of it in their planning, whether it's as complex as today or not, or even more complex because we have more data and more understanding in the future. Eventually, everyone will probably screen and consider non-financial indicators in their decision making. Let's call it that.
Okay.
But impact investing will probably take a little bit longer to become the norm.
So, well, you mentioned extension. So impact investing is not only a subset, might not be correct. It may well be a Venn diagram where they overlap.
Yes.
Might be a better description.
Right, because you can impact invest in every geography, every asset class. It's just an additional layer of scrutiny where you're actually measuring KPIs towards these goals, right? How does my portfolio reduce emissions? And if it's not reducing it to the target I have, how do I shift and pressure my portfolio companies to change their business model to reach those goals, right? We're not just looking at the financial return as a goal.
Okay. Now, before our call, we talked a little bit about trends and opportunities in the sector, in both sectors, ESG and in impact investing. Can we go through some of these in a little more detail?
Yeah, absolutely. So obviously we discussed climate mitigation is a big one. A new topic that is getting more and more popular in the climate space is both adaptation. So we are now on track to miss our target of 2% Celsius as being the max amount of increase in temperature globally. It's looking like we're on track for an increase by 4 degrees Celsius, which really means we're in for a rough ride, regardless of how prepared we are for net zero. If we don't find ways to adapt as well, I'm talking seawalls, retrofitting homes, right here in the wake of Hurricane Ian, what do we do to adapt to more and more environmental crises versus only investing in mitigation? That's a big topic. Climate justice as well is a big issue. So who's going to be hit the hardest by climate change? Probably the most poor communities, the most emerging economies as well, who, by the way, are not responsible for most of the emissions globally and may pay a hefty price for them. So climate justice is a big theme. Smart cities, obviously a topic important to you in this podcast. But yeah, smart cities. So by 2050, it is estimated that most people will be living in cities and they will be accounting for the majority of the world's energy demand. So the more people move to cities, the more energy is needed. Their lifestyles tend to get even more energy consumptive. And I'm reading a book right now that suggests the average person really only needs about 90 watts a day, let's say, of energy, but really to survive, if just food. But we actually use about 11,000 because of all of our social activities and this computer, et cetera. So that demand will actually continue to increase. And
yeah, the whole smart city, as you know, I've been active in the smart city world for domain for quite a while. A lot of the smart city initiatives are driven by the legacy steep model of about 100 human factors that are detailed elsewhere. Societal, technology, energy, environment, and political factors, and all of those have subsets of 20, 25, 30 that are all very, very dramatic and impactful. It's not an easy situation to address and to particularly when you try to balance all of those competing stakeholders.
Right, exactly. That's true. Like even getting things done in that shift must be challenging, but exciting, right? There's a tremendous opportunity there, both from a business perspective and also from an innovation perspective. I think energy transition is obviously a critical one. So that we're seeing in the form of, investment in electric vehicles and that infrastructure, which of course, I'm quite familiar with, distributed renewable energy, the transition to renewable sourcing over natural gas, which is also being driven by this geopolitical crisis in Europe. And we can talk more about the implication there. Health and mental health has come up a lot in the past couple of years. Obviously, COVID drove the health aspect, but also isolation. The things we've gone through post-COVID have really amplified mental health issues. And you're seeing.
Can you expand on that a little bit? I mean, there's an awful lot of anecdotal evidence that is not positive in the health domain, from children wearing masks to all of the discussions about vaccinations, for example.
Right. So I guess it is nuanced. It depends on who you're asking, whether they think we're getting better at that or not. But there's some imminent global crises that are happening regardless of COVID. For example, the aging population. How do we take care of them? Huge crisis that we've never really had to face historically before, because our lifespan is getting longer. Chronic illnesses like diabetes are on the rise. How do we manage to improve taking care of people in that domain? One shift that COVID kind of changed in that space is like telehealth, for example, used to be a lot harder to implement because of regulation and HIPAA, and other things like that. But there's actually been quite a lot of effort to transform regulation so you can give people treatment online, which has been important during COVID, or to access remote areas, rural communities, people without the time to go to the doctor, which is most, people in America that have 2 jobs don't have time to take off and spend a lot of time going to treat some of these conditions. So if I understood your question correctly, I think there have been improvements, but yes, there's also kind of a backlash against over-vaccination, among other things.
Well, I think we're just as a society, we're becoming more aware of health and the negative impacts of some of the things we do. Vehicular accidents and injuries have been going up. Pedestrian injuries have been going up, and it's may well be associated with the rise of the smartphone and people not paying attention, for example.
Right. So trade-offs, and how do you measure those trade-offs, right? We're more connected and able to do more with the phone, but we're distracted and detached from our physical body.
Exactly.
And mental health related to the phone, for sure, right? Social media, they say, is one of the big drivers of mental health crisis in the youth, because people in social media, you can portray your life to be perfect and you look beautiful and all this stuff, and people can bully you without being face to face. So a lot of young people are kind of tormented by those standards and unable to meet them. Also, the isolation from the classroom, other things like that have also led to an increase in depression, anxiety. You don't have the same lifestyle of connection with your work fellow colleagues, although a lot of people are getting back to the office, but that's been a challenge globally. So a lot of startups have been trying to tackle this. A lot of companies are trying to include processes in-house that help their employees with mental health. For example, I just saw, it was Global Mental Health Day a couple of days ago, I believe on Monday. Carlyle, the large private equity firm, posted a long sort of talking points about how they make sure that they include mental health in their employee benefits, not only because they care, but because employee retention is super important right now. They believe that the Great Resignation is partly driven by, dissatisfaction with, whatever their careers, their anxiety about, climate change and health crises, et cetera. So they also want to make sure to be able to attract the best talent, retain them, right? Because burnout can lead to leaving, and that has a cost. and employee engagement. So you're seeing big players like that talking about mental health in a way they didn't used to. I don't know if you want to call that part of ESG as a consequence, but it certainly
is. Yeah,
yeah.
I would consider it to be. Sure.
I do as well. So that's another one. Logistics is obviously a huge issue since the crisis. So we're seeing tons of money being thrown at venture funds doing logistic innovation. In my opinion, from an ESG and impact perspective, making sure that we don't overbuild things that are going to have environmental impacts that are just for a short-term supply chain constraint might be important. Making sure that they're fairly distributed around to protect countries that were kind of boxed out during the COVID crisis and couldn't even get certain fruits and vegetables, et cetera. So you're seeing a lot of money going into that space, and making sure it's done correctly is a priority as well.
Well, that's not only a long physical supply chain, but it also addresses the situation of, say, food deserts here in North America.
Yes.
And issues that are not typically what you think of when you think of the train, ship, plane transportation system.
Exactly. The food deserts in the US is something that has been perhaps is trying to be addressed by different players, and perhaps is being helped by like Amazon, Whole Foods, some of these things where you can get delivered vegetables and fruits into certain areas, but I presume that the cost is still a little too high for the average person. So there's still a lot of work to be done there as well. Cybersecurity. Of course,
yeah, agriculture,
sorry. Yeah, agriculture, huge, both from, like we were discussing maybe prior to the call, agriculture and land use accounts for 30% of global emissions, both because you tend to cut down forests to plant, so that reduces the carbon sink of the forest. Amazon being a classic example. There's tons of Amazon being cut down to graze cows. Cows are producing methane. They're drinking tons of water, and you're cutting down the trees. So it has a triple negative effect on the environment. So how do we change the way we do agroforestry, including you're seeing this advent of alternative meats, right? Lab-grown meats would presumably reduce the cost of meat production dramatically, if for those who do not want to eat vegetarian or vegan, of course. You're also seeing a lot of like meat-based alternatives like Beyond Meat, Impossible Foods that were founded to tackle this issue specifically, right? The founders of Beyond Meat wanted to impact climate issues, like they're a social enterprise, let's call them, because they built the company for that goal. And they wanted to attract people who like meat, right? Have the texture, the color. So they wanted to bring people over to vegan. I think that's going to go from sort of good to have to eventually mandated in some ways because of how dramatic the impact of agroforestry and cattle raising is on the environment.
Can you talk a little bit about regenerative and distributed agriculture?
Sure. So regenerative agriculture is kind of retro technology. So we're saying rather than growing food with a lot of soil disturbance, where you're bringing in products that are not from that area, pesticides that kill any insect there, how do we use the natural elements of that terrain, which sometimes are growing other plants around it, keeping certain animals there that are actually native, that tend to eat the bugs that you were then using all the pesticides for. And they often include having still forest interwoven, right? So in the US, we see all these like big, agricultural lands with absolutely no forest, absolutely no other plants around them, no diversity in the agriculture. And that's one of the reasons that they're so unprotected from insects and other, let's say, fungus, et cetera. So they're trying to find out, how do we go back to some of these traditional agricultural techniques that are actually regenerative to other things in the area as well, other animals, that provide carbon sinks with the trees, et cetera. And also what I mean is by distributed is, again, that we're seeing, for example, Ukraine grows 25% of the world's wheat. So this crisis, maybe we didn't think, oh, what does the invasion affect our global supply chain of food? Well, it does tremendously. And the fact that we have all of it being grown, 25% being grown in one region, puts a lot of risk into that. If it was climate instead of war, same thing, right? They could wipe out this entire crop and then we'd be, lacking food for Somalia and different regions, which were actually negotiated Putin negotiated with the World Food Program to allow certain baskets of wheat to exit to famine-based countries, but those things have a huge human toll, right? That we don't really think about. So should we have a lot of concentration of one crop in any one place? Probably not, given the risks ahead. So what I mean by distributed is that it's distributed around the globe rather than concentrated in one place.
That makes sense. I know cybersecurity is a big one.
Yes, cybersecurity is one that I learned actually a lot at your conference about, just how much constant attacks are happening on power plants, the grid. Every other company in the world is being affected by this. And it can affect you and me on data, right? Like we've seen a lot of data hacks, Equifax, the hack into Equifax that released, 200 million credit scores to the hacker, not only had an impact on you and me, but also on their stock. Their stock price took a huge hit. They had to go through a whole, revamping of their business model to gain trust again. So those are the kind of things that do have an impact.
Yeah, it's not only the obvious examples of some large database with your credit card being hacked. It's also since IoT continues to grow at a faster and faster rate, many suppliers often will take a non-communicating device, internet enable it, and not enhance the security to today's levels. And as a result, that often is the entry point. And there are numerous examples of, it might be the air conditioning system allows the hacker to come in and then go to the accounting system, or entry points like that. So there never will be a complete answer there. That requires persistent and constant vigilance. You also, as we move forward with that discussion, we do want to take ownership of all levels of the engineering of those chipsets. And that's something that is evolving, and it may even require, there's been some proposals for even a blockchain record of who has touched all of that technology in that chipset, so that no malicious actors can have a backdoor.
That's fascinating.
It's a challenging situation that continues to evolve, and is only going to be more serious as we had talked about for autonomous vehicles. No one wants to ride in an autonomous vehicle that has been hacked. Certainly.
Exactly. No, I even think about that when I use my self-driving on the Tesla, that it could one day just be hacked and taken over, right? And I wouldn't have any control over it. No, that's
exactly
an amazing point. We talk about trade-offs in ESG and impact all the time, and there's a trade-off, right? We want to be more interconnected so we can manage things at the smart city level with big data and all these things, but that also means we're opening the door for a lot of systemic connections that, like you said, a hacker can get in one system and then find their way through another. And that's something that, we're going to have to keep addressing and investing large amounts of capital into to protect, like I think you mentioned at your conference, that the power industry is the only one today that is really regulated on how cyber secure they have to be, whereas the rest is relatively voluntary, but that likely this will become more and more security issue as things become more autonomous and interconnected.
It certainly will. Here at ARC, we are doing some research, and we'll be publishing some papers on ESG data monitoring and evaluation solutions. I know you've been active in that space. That's the last of our trends for the sector.
Yeah. So that's super important, right? As we talked about, there is a ton of pressure to report on ESG, with 92% of the S&P reporting on ESG metrics. But how we understand the data, what data is accessible, how to use it, who's the source, is a big question mark still, right? And that's one of the things that makes people skeptical, right? Okay, oh sure, this company is reporting on all these metrics, but how do I even know it's true? What does it mean? How does it really affect real life situations? That part is still dynamic, which I think is important, that it remain dynamic, that we still want to learn and understand, and make new connections about what the impact of a social policy is on the long-term sustainability of a company. And by sustainability, I mean their ability to sustain, not necessarily anything else. We'll learn that over time, but those data providers are going to be super key to making sure that people trust the information, that it is somewhat impartial or third-party governed. That's why you see all the big data providers getting in the space aggressively, Refinitiv, Morningstar, Bloomberg, you name it, everyone is trying to get in this space, trying to understand what data is important to whom. And on the impact side, also, impact investing is even more concerned with measurable data that can prove that they're actually having the effect that they want on that strategy that is addressing a real world problem, right? So one startup that recently got funded that I've been watching spun off from an impact investor that was having trouble managing how do they measure a intervention in Kazakhstan, you know, without being on the ground. And I think you and I talked about this before the call. What is the actual person we're trying to help think about the intervention? Sometimes that chain of understanding the beneficiary and actually reporting that back to the investor gets lost, right? So going to the ground and surveying the people we want to help, or the customer that we're really trying to impress with our ESG strategy or hold on to, whatever that may be, communicating and serving the beneficiary is very important to making sure we're having the intended impact that we set out to have, that we're not having a negative impact that we didn't expect. And I'll give you a classic example that comes more from philanthropy, but Bill Gates was, a foundation was at some point installing pumps in Africa for water, but without engaging their beneficiaries, they didn't realize they were installing them in the wrong place, that nobody knew how to use it, that like it wasn't culturally understood as to why it was even for, so it was being completely unused after all those millions of dollars were spent trying to solve a problem, right? So that's why talking to the user is so critical, and understanding their needs and reiterating when we are wrong, right? So like changing that perspective.
That's fascinating, Julia, because in the excuse me, in the transportation world in the US, in order to access funding, not only from the US DOT, but from the Department of Energy, NASA, you are required to do a systems engineering audit, which very strictly requires you to define your stakeholder communities, poll them for their user needs, collect and see which of those have consensus, which then in step one leaves you with a document that is a list of narratives, narrative-based user needs. In step two, you refine those into measurable functional requirements that then become your project specification or your requisition form. But there's also an overlay that is a test plan, so that you make sure you're satisfying only those consensus-based needs, and no supplier or other interest has introduced some other need that might tilt it towards protect one vendor or further change the solution. That little description I just gave really is the a layman's version of the waterfall model of software engineering, and it's what you need to do to access intelligent transportation system funding in the US.
That's very interesting. And is this transportation funding related to this Inflation Reduction Act, or we're talking about?
Oh no, this has been for since the dawn of the intelligent transportation system effort here in the US. It was early on, predates me, But early on, it was determined that, you just couldn't make roads wider and larger. You needed to apply technology. But the
Right.
integration costs were so expensive that it really needed to be defined each step of the way. And we can talk about that later.
But I love that example. It's very similar. That's how, and you, like you said, in software, you're often iterating, testing, understanding, because often when you build something in your mind, it has a function that not everyone understands as well. So I think that's why
No,
software.
exactly. And if you follow that model fairly strictly, you are testing the even at the sub-device level, you will test the I don't know, the call box or on a road or traffic signal at the manufacturer's site, so that it doesn't arrive if it doesn't actually match what you wanted.
Fantastic.
So what do you see for the future in both impact investing and the world of ESG?
Well, I see that despite some of the challenges that I think we're seeing in the ESG market, what do we measure? Is it politically appropriate or not? Is there consensus, et cetera? There's certain things that are kind of, I like to call them the trains that have already left the station, that we really, regardless of whether politics is debating certain things or we're not sure exactly how to measure and what, there seems to be a commitment to sustainability across corporations that is unprecedented historically. So we're seeing, I believe we are now at about 1/5 of the world's public companies, largest public companies, have committed to net zero targets. An alliance of the world's pension funds have committed 2.4 trillion to carbon neutral investments by 2050. Again, these are long-term horizons. So, we have a bit of time to get us there. Net zero asset managers are a big segment now, with 61.3 trillion committed to a net zero framework by 2050 or sooner. And we're seeing large governing bodies like the World Bank, IMF, G20, COP27, getting together to discuss not just climate change, where we're seeing people represented on the right, the left, autocracies, different religious countries with different religions, all coming together to think of, okay, how do we make the world more adapted to climate change? What can we mitigate? And then how can we address inequality, which, if not addressed, will probably lead to political instability, among other things, particularly with all these other social pressures, environmental pressures. So, I don't think we have the roadmap finalized. I don't think we know exactly what's going to be important on the measurements side based on what, the future holds. But is there a sort of a movement towards including non-financial indicators in how we manage businesses and how we invest? Yes, I think so. And I don't think that's going to change unless, unless other things take precedent, right? Like war generally blocks any economic development and environmental initiatives. So hopefully we don't see a global war, but things like that can derail us, right? Pandemics shift our attention to the immediate from the long term. But in the long term, I still see that there is a consensus to try and understand how better to include stakeholders in our value chain as generating important value, right? Before we talk about the Milton Friedman worldview of stakeholder capitalism is also become a bit outdated. And now we talk about shareholder capitalism because we have informed customers. We have employees who are willing to resign if they don't agree with the way that the morals of and purpose of their work aligns with their own. We see the environment being considered a stakeholder, not just because of climate change, but because improving efficiencies across your value chain can save money. So you're seeing these shifts kind of, in my opinion, regardless of the broader sentiment today. We didn't talk too much about some of the sort of market issues that are complicating ESG transition, but just to mention them briefly, of course, inflation and a possible recession not only have turned people off from, let's say, taking risks that they're not used to, right? Or going, let's say, a lot of people are not investing in venture if they can invest in, much more safe products at high interest rates. However, we're still seeing, despite the market decline and venture kind of going down to historically low levels and for the past 5 or 10 years, we're still seeing climate action, climate tech investing lined up to be the same as it was last year. I think it was about 40B last year, a record year for climate tech. That still looks like it's going to happen this year again. So that's kind of a sign that people are looking long-term in that space at least, and willing to take a little bit more risk despite inflation. That may be partially because of, buffers to that, like the Inflation Reduction Act is putting a ton of money into the space. Venture capitalists feel like, okay, that kind of protects some of their investments. They may have been willing to dip into things they're not used to, like infrastructure, because usually they want to do more software-focused solutions. So that, I think, is a positive for the long-term climate investment space. Oil and gas, which has been driving a lot of inflation, we probably will see a bit of a shift to more investment short-term in exploration, or at least in continuing to invest in things that protect from what's happening right now, right? We see a little bit of the OPEC cartel raising the cost of barrel right now in the middle of the strongest demand ever. So, there's a need still for oil and gas. We can't get rid of it overnight. There'll still probably be investment in the space, but this issue with Ukraine and the global trend still suggests, in my opinion, that people are going to look for midterm for energy solutions that provide more independence, more security. The cost of renewables is now, the cost of capital to finance renewables is lower than oil and gas now. The cost of implementing those solutions long-term is expected to continue to decline. So arguably even the cost of energy could go down long-term. Sun and wind are limitless. They don't have a finite amount globally. So, in a way that is also very different from our current energy structure. So I mentioned that to say that I think that is a short-term kind of a blip that is driving a lot of concerns about ESG, because performance has taken a hit in public market portfolios that were weighted ESG. However, I think in the long run, if you're a long-term investor, you don't have to sell right now. The trends still point to a shift away from oil and gas. I don't know if you agree. I'm curious your opinion.
No, that was a fascinating summary. But Julia, this has been a great almost an hour.
Oh, wow.
Yeah, it's been fascinating. Do you have any? We're just about out of time. So, do you have any last minute words for our audience?
Yeah, I think I think we're in a complex moment in history, but I think there's a lot of hope that we can come together across political parties, across governments, and build a sustainable world. I'm inspired by, someone shared with me recently that, Will Shatner, who recently went to space in the ship, Star Trek fans may enjoy this, he thought he was going to have such a blast up there, but he kind of looked back at the Earth and felt grief. He said he felt grief because we don't appreciate what we have here, the life that the rest of space seems to be like, at least the visible one. And that, the wars, the things that divide us seem so inconsequential when you're looking at the planet from far away. And I think there is a hope and a kind of a shift in consciousness about that globally that will lead to more and more efforts. There may be a pendulum swing back and forth, like, are we going too far in one direction? Are we measuring the right things? Are people just using this as marketing? All of these things will still shake out. But I think in the long run, the idea that the globe is thinking more thoughtfully about how we can collaborate towards major economic growth, towards how we even measure GDP, which is a whole another topic to discuss another day, but which really doesn't measure externalities or the cost of depleting resources. So I believe that there's an opportunity here that is going to create jobs, right? The sustainability transition, they say, will create at least 22 million jobs. We're going to see cleaner air, hopefully in the future, which means less disease. If we can resolve inequality issues, that will hopefully bring people out of poverty and still strengthen the economies of the world. So I'm hopeful, and I think this is just the beginning. So I appreciate having a chance to talk with you about it, and hopefully we'll have many more, and we'll be able to look back at this day and say, oh, we've made so much progress. And
Great.
and we're doing
Well,
so
Julia, thank you very much for joining us today. If some of our listeners would like to contact you, can you share your contact information?
Absolutely. You can email me at julia.wilkinson@I am as in Mary, VEST.co. You can also go to our website, invest.co, and message us from there, or follow us on social media on LinkedIn or Instagram.
Well, once again, I'd like to thank Julia Wilkinson, CEO and founder of Imvest, from Miami, Florida, and joining us today to talk about ESG and impact investing, and there's just a variety of different subsets of that entire ecosystem. Thank you, Julia, and thank you to our listeners today. And we will look forward to seeing you soon on another episode of the Smart City Podcast. Thank you.